Hello and welcome to this FNO Masterclass. FNO for investors is the topic of today's webinar. Now, the last FNO Masterclass was meant for traders. This one is meant for investors. Now, one would say FNO and investors, one would be surprised. What has FNO got to do with investors? You would think that the suggestion is absurd. FNO is meant solely for traders. Why would an investor look for an FNO, for using FNOs? Now let us check as to the how the world's one of the world's best investors look at FNO. Warren Buffett, in his annual letter of Berkshire Hathaway in the year 2002, mentioned that derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. In the same letter, he also mentioned that indeed at Berkshire, I sometimes engage in large-scale derivative transactions in order to facilitate certain investment strategies. From 2004 to 2007, Berkshire sold puts in just about any other markets. It was bullish on the entire world markets. So Warren Buffett went long on the world just by selling puts. After his 2008 letter, in an interview, he said that so we use a lot of things daily that are dangerous, but we generally pay some attention as to how they are being used. So Buffett's decision to take advantage of this mispriced financial instruments or contracts has earned Berkshire shareholders billions of dollars of extra income over the past decade. So basically, what is important is how you use them. As an investor, you just don't have to shirk away from FNO. There are ways and means in which FNOs can be used by investors and not just traders. Now, what are the uses of FNO for investors? Basically, FNOs can be FNO segment or FNO instruments can be used by investors for hedging. Is number one. Number two is to go long with a lower outgo, and number three is earn income on your core holdings. So these are the three ways in which FNO instruments can be used by investors. Now, the first one, let us take the first one. First one is hedging. Now, a hedge is an investment that protects your portfolio from adverse price movements. Adverse price moves can be due to unseen or uncertain events. Lately we have seen the way markets have behaved. They have tanked over the last few days due to unseen or uncertain events. So this is a classic example of why you need hedging. If you are holding a portfolio of stocks, then you have to protect the value of that portfolio by hedging them at a particular point. You don't have to hedge it every now and then. Whenever you feel that the risk of a bubble formation or prices which are slightly beyond their intrinsic value across the board has happened, then certainly there is a possibility of some event, maybe a black swan event, which will pull down the value of your portfolio. So in such circumstances, you need to take protection against your portfolio. You need to hedge your portfolio. Hedging strategies are normally used by investors to reduce their exposure to risk in the event that an asset in their portfolio is subjected to sudden price decline. So individual stocks can also fall and the whole portfolio can also fall. So when properly done, hedging strategies reduce uncertainty and limit losses without significantly reducing the potential rate of return. Hedging typically involves buying securities or instruments which are inversely correlated with a vulnerable asset in your portfolio. So in the event of adverse price movement in the vulnerable asset, the inversely correlated security or the instrument should move in the opposite direction, acting as a hedge against any loss in your vulnerable security. A put option on a stock or an index is a classic hedging instrument. Selling futures also helps in hedging, but the modalities and risk return ratios are different in futures versus options. At times, hedging may also be resorted to from tax considerations. Basically, if you want to lock in your exit price, you feel that the stock has run up quite a bit, but because of the time that has passed, you don't want to sell your stock, but you at the same time you want to lock in your exit. So then you can use futures. You can sell futures, keep rolling them over till the time the time in your mind about holding the stock is over. So maybe you will hold on till 1 year from the date of purchase and pay a lower capital gains tax. That is one way of looking at it. Or when you are expecting unfavorable short-term developments in a particular stock. So, for example, if you are holding a stock which you feel over the next month or two can fall due to particular reason, but over the longer term you still want to hold on to the stock. So, in such a circumstance, you will keep holding to the stock, but you will for the interim, for the 1 or 2 month period, you can sell stock futures, buy them back when the stock reacts down, and then sit on the tight profit which you wanted to do. Thereby, you will remove the uncertainty in terms of fall, decline in the stock price. You may not, you don't know when the stock price will revert back to the original levels. But in the meanwhile, if you have that profit in your pocket, you are happy to continue holding that stock without too much of a botheration. Also, when you want to do bonus stripping, but don't want to take the price risk, uh, hedging will help you. You can sell the stock futures and carry it on for 1 year, and then probably reverse the transaction, thereby taking advantage of the short-term capital loss by selling the original shares immediately on the allotment of bonus shares, and selling the bonus shares after a period of 1 year, and pay concessional tax on that. In the meanwhile, you are protected from the fall in the price of the stock if you have sold stock futures in advance. Now, how do you hedge? There are various ways in which you can hedge. One is you can hedge using stock futures. Now, one can sell the same stock futures so that any temporary fall in that stock price can be protected in as much as the fall in the stock price can be almost equally offset by the profit in the futures. So if you feel that a particular stock is likely to fall, then you can sell this futures. If the stock price actually falls, then you will make a notional loss on your stock holdings, which will be compensated by profit in your futures. This position can be taken in multiples of lot size. Now there is a concept of lot size in the F&O market, which is typically between 5 lakhs to 10-12 lakhs per stock value. So you can take exposure in the multiples of lot size, and it also involves payment of margins. There are two types of margins: initial margin and mark-to-market margin, which is paid on a day-to-day basis, paid or received based on the difference in the stock price. Now, there is an example which we have mentioned in the on the slide, which says that if you have bought say 500 shares of TCS at 2070. And so you are long in the spot market, but if you feel that the quarterly results of TCS may not be as good, so there may be a short-term fall in the price. So to hedge your position, what will you do? You will go short in the futures market at say 2075. Lot size is 500, contract value is 10.37 lakhs. Long in so you are long in the spot market and you are short in the futures market. Directionally you are neutral. So in case the stock price falls to 2000, what will happen? 2100, what will happen? And 2200, what will happen? So your profit in the futures market is getting offset by the loss in the spot price and vice versa. So on an overall basis, you are as good as neutral. Now, the second way in which you can use hedge, you can create a hedge is by buying put options. Now, put options typically give investors a right to sell an asset at a specified price within a specified time frame. The pricing of the option is determined by the downside risk in the stocks. Now, this also keeps changing based on the market condition and the conditions in the individual stocks. So one can buy put option for the month till which the uncertain event is expected to occur. So, for example, if you are expecting in 2 months a negative development to happen in a particular company, then you will buy put option of the second month. Typically, liquidity in the Indian markets are good in the near, next, and third month. So 3 months contracts have good liquidity. So if you feel that in the second month something negative is going to happen, then you will buy the put option in the second month. And by buying a put option, you are paying out a premium. Now that premium is the total of time value and the intrinsic value. Now intrinsic value is the difference between the strike price and the spot price, and time value is the time to expiry of the contract. So as the expiry date nears, the time value, there is a time decay happening, so your time value keeps shrinking. So there is a loss involved in the case of premiums, especially on the time value side. So you have to be careful about the time period in which a particular event is going to happen, because otherwise you may incur loss on the time value. A protective put strategy is usually employed when the option trader is still bullish on the stock he already owns, but wary of uncertainties in the near term, as we mentioned earlier. So now again, going by the example, if an investor has purchased 100 shares of ABC at 100 rupees and the price has increased to 108, now he wants to lock in that profit of 8 rupees, then he can purchase a put option in the same stock that will protect him as long as the option contract is in force. So what happens when the stock price is at a particular level on expiration? We have given as in the table. So there is a profit or loss on the stock position, there is profit or loss on the put position, and overall profit or loss. So basically, the premium that you pay out is a loss that you incur, and that is recovered in case the stock price moves in your favor. Otherwise, there is an outflow. So 3 rupees 25 paisa is the maximum outflow that you witness if the stock price does not move in your favor. Next. Now, the next kind of hedge that you can create is hedge using portfolio beta. Now, this is used when one has a portfolio of stocks, some of which may not be part of FNO list, and or holdings in some of which may be below the lot size as prescribed in the FNO segment. Now, beta measures the systematic risk of holding a stock or portfolio in comparison to the market. A beta of 1 means that the stock or the portfolio will move in line with the market. So we know of several stocks which are highly volatile, and some other stocks which are defensive and don't move as much as the market. So basically, we are talking about beta unknowingly. So when a particular stock moves up or down more than the market, it means that the beta is more than 1, and vice versa. Now, beta hedging involves reducing the systematic risk by purchasing stocks with offsetting betas. Portfolio beta can be calculated by multiplying the stock weights by individual betas. Now, if you have 5-7 stocks, what is the weight of the value of each stock in the overall portfolio? That is what you will have to first calculate. What is the individual beta? Now, individual betas are available on the NSE websites, so you don't have to hunt much about it. You can input that individual betas, and by doing a weighted calculation, you can arrive at the weighted beta of the portfolio. Now, once you have the weighted beta of the portfolio, you have the value of the portfolio, you can multiply the two and arrive at the value that you need to hedge. And that you can hedge by way of either futures or options that we have discussed earlier. Betas are also dynamic and keep changing from time to time. So you will have to take the current most beta. And at times, between the time you take a position and the time you sort of exit the position, there may be a variation in the beta. So that will be a small mismatch in the hedge, but that you cannot avoid it. Now, so as we discussed, there are a few steps involved in hedging a stock portfolio. We have discussed that. Now, if you have, say, Axis Bank, which is worth 1,25,000 out of 8 lakhs, the weight is 15.6%. The beta of Axis Bank is, say, 1.4. Next, we'll keep continuing with the same thing. There is there's a table which we have shown in which there are some 8 stocks with different values and different betas. There is calculation of weighted beta which is available on that. then the sum of the weighted beta is multiplied by the value of the portfolio, and then we get what is the requirement of the hedging that we need to do, either by futures or by options. So in the next slide, we come to the value of 9,78,400 versus the portfolio value of 8 lakhs. So this is a high beta kind of a portfolio, and 9,78,000 is the value that needs to be hedged. So now, depending on the lot size, you will have to either hedge 3 or 4 contracts, 4.33. So you can do either 4 or 5. So if you do 4, then you are under hedge. If you do 5, then you are over hedged. So now, what happens if you take sell futures, and what happens when the Nifty moves up or down? For example, Nifty moves down by 500 points, and so your profit on the futures position is 54,125. On the other hand, the portfolio value has come down by about 54,240. So this is exactly matching. This is the purpose of creating a hedge, that you did not want your portfolio value to go down, and that is why you take a hedge through a year. In this particular case, you do it through Nifty futures. So next way you do a hedge is by delta neutral strategies. Now this sounds a little mumbo jumbo, but let me explain it a little in detail. Delta neutral strategies are option strategies that are designed to create positions that are not likely to be affected by small movements in the price of a security. So typically what happens is that you ensure that the overall delta value of a position is close to as zero as possible. Now, what is delta? Delta value is the ratio of change in the price of option in response to change in the underlyings. For example, a particular stock is quoting at say 100 rupees, and 100 strike price call option is currently quoting at say 6 rupees. Now that price moves up from 100 to 102, the 2 rupees move up. Option price will not move up by 2 rupees. It will move up by less than 2 rupees. Now, how much less is what is delta is all about. So it will move up say by 1 rupee 50 paisa. So 1 rupee 50 paisa upon 2 rupees, that is 0.75 is the delta of the stock, delta of the option. Now, delta neutral hedging is a very popular method which is used by traders who hold long position in stock that they want to continue to keep holding, but they are concerned about a short-term drop in the price. So again, this is meant for investors who think, I don't want to forego this portfolio which I have built very painstakingly over time, but at the same time, I feel that in the interim there is a possibility of the stock prices going down, and I don't know how far deep they will go down or how long they will continue to remain down. So in that case, I can hedge by doing this delta neutral hedging. So now there is an example which is given on this slide. So delta neutral refers to any strategy where the sum of your deltas is equal to 0. So for instance, if you buy 10 call options, each having a delta of 0.6, and you buy 20 put options, each having a delta of minus 0.3, you have a total weighted average of 0. So your position delta is 0, which means that you are delta neutral. Now let us consider this by an example. Consider that a share is available for 110. Put options for the strike of 110 is available at 0.91 rupees, and whose delta is minus 0.42. So in the case of put, it is always minus because the put price will move inversely with the stock price. A delta neutral strategy can be constructed using the stock and the put options. Now, firstly, you need to have 210 shares in stock which are purchased at 110. Now, basis of choosing 210 is that a delta of 5 put options is minus 0.42 into 5 into 100, thus making the delta 0. So for stock, the delta is 1, and for options, we have taken it as minus 0.42. So on a total weighted basis, we are coming to the delta position of 0. Now, if the share price increases from 110 to 112, the profit on shares is 420 rupees. The put price will decrease by 0.07 paisa. So the loss on put options will typically be actually the put price will fall will fall by 20 paisa. So 71 paisa is the fresh price. So loss on your put option will be about 355 rupees. So net profit is still 65 rupees. So there is a profit of 420 on your stocks. There is a loss on put which is 355 rupees, and overall there is still a profit of 65 rupees. So by this way you can protect the value of your stocks or your portfolio. So there are various ways by which you can hedge your portfolio. You may take a little time to understand this a little more deeply, but there's a lot of material available on the web, and in case you want, we are available. Our relationship manager, our derivatives product team is available to clarify any of the doubts that you have, so that you can benefit out of taking this hedging positions. So now we are coming to end of this webinar. In the next webinar, we will talk about how investors can go long with a lower outgo and earn income on their core holdings. So basically, as we discussed, these are the three things where the investors can do. We have covered the first big thing today. The balance two things we will cover in the next webinar. With this, we come to the end of this webinar. We hope that this was of some benefit to you. Thank you, and have a great trading experience.